We're here to talk about the Silicon Valley real estate market analytics on June 8th. This is a new summary slide. It's going to give us a recap of what's going on. We have inventory. This is current inventory, but not including those properties that are on the market looking for backup offers. This is where we were 13 weeks ago, a quarter ago. The number on the right-hand side is where we are. The three fine color lines are the most inventory you'd expect, the typical inventory you'd expect, the gray line. The purple line is the data line, and the red line is the least inventory you'd expect. Right now, we are 11% of the inventory you'd expect at 2,410. Moving down to offers accepted, and again, my definition is different. I look at only offers that were accepted that are still pending or closed, so those escrows that fail within 5 weeks only count for part of the time. And the other huge advantage is every transaction counts for the same duration, where if you look at pending sales, a property that's in escrow for 9 weeks counts for more, impacts the data more than a transaction that's in for 3 weeks. But the other major takeaway is we're only at 80% of the offers accepted. And because the offers accepted percentage is lower than the inventory, this is not a marketplace where transactions are restricted based on lack of inventory, as so many people have claimed. And you can see that the offers have been below normal for a long period of time, and you'd have to do a ratio, and I don't have all the numbers handy right off here, comparing it to see if it's got a possibility, but I don't believe so. And I think the next slide, which is days of unsold inventory, and this is basically the seller-buyer balance. And again, a lot of sellers and not many buyers gets you up here on a slow marketplace on the blue line, then the gray line and the purple line is the current data, and then the red line's the fastest pace, fewest sellers and the most buyers. So right now we're at 7% above where you'd expect. And if you were to be in a marketplace that's restrained by inventory, this would have to be a lower percentage because that would indicate a lack of inventory. Then we move on to days on market, which is the time for the typical seller to sell. And a quarter ago, it was 16 days. Now it's at 14 days. But again, real estate is very cyclic, so I think it's more important compared to normal, and it's 82%. So sellers are selling their properties in 82% or 18% faster than they typically do. And then we move on to ask price reductions. And this is basically sellers' expectations when they went on the marketplace versus the reality of the marketplace. And this is a very tight metric. By that, it doesn't change very much. So a quarter ago, we were basically taking 0.5% price reductions. Now we're taking 0.6% of price reduction. And that's because the vast majority of the sellers don't take any price reduction at all. And somewhere around 10% of the sellers are taking the price reductions. And that's 131%, so 31% higher than normal. So the normal number would be somewhere around about 0.4% reduction. And a quarter ago, it was double. So back here, the typical reduction was only 0.25%. And now we have a huge chasm here, because these are what I call current or leading indicators. They're telling you where the market's going to be going. And, we could have a debate on whether they're leading indicators or current indicators, but they're closest to the current indicators that we have, because anytime you need the sold price, you're waiting between 4 and 6 weeks. And that's just a typical range. Some escrows close in a week. Some escrows take 9 or 10 weeks to close. Some take 13. There's some on the MLS that have been on for more than 14 weeks that I know right off the bat. But in any way, there's an untypical of 4 to 6 week delay. And the first one we're looking here is overbidding. And this shows offer competitiveness. So this is how competitive buyers have to be with each other to get a property. And again, here's where we were a quarter ago. Here's where we are now. The typical number right now is 9.5% overbid. That's 2.7% more than typical. So if you subtract off, in this case, 2.7% off that in rough numbers, you're somewhere around 7%, 6.8%, I think is the actual number. So typically you'd expect 6.8% overbidding for this time of the year in Silicon Valley, and currently we're at 9%. So you can see that we're above the gray line. And then you go on to the monthly payments. And here you can't really compare to where you're supposed to be or where you typically are, because you have long-term appreciation. And the monthly payment, which assumes an 80% loan, 30-year fixed mortgage, and you have to multiply this by 1,000. So this is 11,000. Convert the period to a comma, $965 is where payments were a quarter ago, and now they're at $13,674. And of course, that's an approximation, but Excel calculates everything out way past the points of accuracy. And then you have the price down here, so you can see that we've gone up basically $165,000 in the last quarter, which is not bad appreciation, but this is the time of the year when the market typically appreciates pretty rapidly. Now, here's another summary slide. What we're going to be getting into later is the heat maps, where you show 20 different micro market areas in Silicon Valley and how they're comparing today to the other areas. And then you have a summary sheet, and then we have distributions, and I show distributions for days on market, house price reductions, and for the overbidding. So let's get into actual data slides. So here you have the inventory in the purple. You can see, as I said earlier in the introduction, you're below 90% of the inventory you'd expect to have. Your offers accepted are at 80%. So the offers are below the inventory, giving you a higher DUI, these are balance of the marketplace, and that's up around 108%. I don't remember what the exact numbers were. Moving on to days on market. Now, here what we're looking at is the distribution. So every transaction for the week. So right now we're looking at a year ago. So that's June 7th, 2023. We looked for a 5-week period of time, and we plotted every data point. And that's this blue dash dotted line down here. The purple dotted dash line is the current. So we're a little bit cooler this year than we were last year, but we start off a year ago on the blue line here, and we step through. So you can see that it's slowing down, a little bit of a plateau, but now you're really starting to slow down. That's the slowest, and then you speed up with the New Year's, and now you're sort of at a plateau. We're about ready to hit the peak. That's the peak. Now we're sort of at a plateau, but slowly slowing down. So the market has definitely turned. I believe it turned on, I think it was April 26th, potentially April 19th, but I think April 26th is more realistic. It takes a while for those transactions to work through the system, for people to realize that the market has turned, and also the prices get recorded. Now, when I say the market has turned, this is not the market crashing. This is just the typical seasonal cycle that Silicon Valley goes through. The single-family homes go through a bigger annual cycle than condos and townhouses. Moving on and doing the same type of thing with price reductions, here you can see the purple line is the current data. The blue dotted dashed line up here is a year ago. And again, a year ago, the market was hotter than it was now. So sellers were taking less price reductions a year ago than they are now, or they're taking bigger price reductions now than they were a year ago. And so the reference line is, we're starting off with this blue dotted dashed line. We're stepping through, so you can see the slowdown. That's about the bottom of the marketplace. Now you have the huge run up in the spring. And right about there or there is the peak of the marketplace, and that was the 19th or 26th of April. And you can see we've come down quite a bit since then, and we're currently on the purple line. So we've come from here down to here. So that means sellers are taking bigger price reductions. Here's the vertically is the amount of price reductions, or horizontally is the frequency of the additional price reductions. Now we're finally going over and looking at what the buyers are doing. So this is the overbidding and the competitiveness between the buyers. Now, again, remember, this is going to be delayed 4 to 6 weeks, but the concept's the same. A year ago, we were down here on the blue dotted dash line, and we're up here on the purple. So on overbidding, the buyers are overbidding more this year. And how does that make sense when the sellers are taking bigger price reductions? Well, the sellers were expecting more out of the marketplace, so they were asking more, but the market is actually hotter than it was, and buyers are feeling more competition. So they're bidding more higher amounts over asking price to get the properties. And that's why the improvement on this slide. The other thing is, and this isn't the whole thing because there's a delay on both of these numbers, but remember, this is data 5 weeks ago. And if you take off 5 weeks or where we are now, you're basically right around that April 26th timeframe. But all that means is we're going to be coming down from the peak. And I think you can already see there's solid lines higher than the current line. So this, in fact, has come down. But again, we're starting off a year ago with the blue dotted dash line here. And you can see we're a little bit plateau. and then you went down for the fall down, and now you have the spring jump up, and now you have a slow migration up, and now you're about there, and there are the two peaks, but you really aren't falling down there. And now right there, you start seeing the last 2 weeks, you're starting to see the drop. So the peak was more of a plateau, but it was actually peaking right around the same time frame, but it didn't fall. And that was what we were looking at on the other slides, is when did it start to fall? This is the halfway point. Here's a quick recap. That was Silicon Valley Real Estate Market Analytics in Greater Bay Area. To get to the presentation, you go to the YouTube link, or you can type in a shorter, tiny URL. I call that my root URL in green. The presentations are Saturday morning at 9 o'clock. If you add in 2024, you get to that live presentation. If it asks for the passcode, it's right here for you. If you want the handout, which is posted, you put in the green root URL plus H 2024-0608 for today's date, any past specific episode, or you can go pick the ones you want from the YouTube. I'm Richard Calhoun. My contact information, working with buyers or sellers since 1981. And I would really appreciate people liking and subscribing to my video. It does help get the video out to more people, and that's part of the reason I'm doing this. So now we're getting into the nitty-gritty of Silicon Valley, and we're looking at each individual component. So now we're looking at inventory. The purple line is the current data. Here's the least inventory you'd expect. The gray line is the inventory you'd expect. So you can see there's a shortage. The vertical distance is a shortage of inventory, but you're quite a bit higher than we've had in the last 10 years, but we're way below the most inventory we had, which is a cool marketplace. We go all the way back through 2014, but in 2023, January, we changed the horizontal scale so you can see the changes. So you can see the little fluctuations a lot better. So you got a full year on the broader scale, and then the current year on the broader scale, and then the long-term cycle of what you expect the market to do. These buying line-term markets are going to be changing every year as we get 1 year near data. I look at a year ago data back for 10 years data. That's my 10-year median. I don't use the current data to influence where you'd expect the market to be. So you're lagging from 1 to 11 years ago for the typical marketplace. And that changes every year as we have more than 11 years of data. So now what we do is take that gray line and stretch it out straight. And you can see here, you're on the downward side. So you're only at about 89% of the inventory you'd expect. So that's a seller's marketplace, which is why it's shaded in pink. I used a line here because it corresponds to that gray line. It's straightening it out. I did not use a red line down here because the red line isn't the same. I'm using red shading and I'm using blue shading. So you can see we're in a fairly strong seller's marketplace, but we've been in a stronger seller's marketplace. And, we've been clearly climbing, especially starting at second quarter, the inventory. We've been getting more and more inventory relative to normal. Same concept with the number of offers. And again, this is offers accepted and still valid in escrow. You can see that in 2023, we had very low inventory, below the level of inventory you'd expect. We started 2024 that way, but then we crossed over again right around second quarter, and we're now above. But look at the sharp downturn. So we're sort of following the pattern of the cool marketplace, but we're slightly above the cool marketplace. This is the same concept where you stretch out the gray line, and here you can see inventories at 80%. 80% is less offers than you'd expect, which would favor the buyer. Red up here, we've not been up in the red for a while. The only time I'm really showing us strongly in the red was in 2020, 2021, and 2022 early, basically post-pandemic. You can see the pandemic spike here came way down. Then we came up and we had the rally after the pandemic, shelter in place, let us show properties. You had the peak in 2021, and then you slowed down. And the offers slowed down, but the peak of the marketplace was right here, basically, right around February 14th of 2022. And then the market did the huge correction. And when you go back over time, you'll see there's nothing that compares with this vertical decrease, the duration of it, or the steepness of it. This is looking days on sold inventory. You can see that you're above the gray line, below the blue. So slower than a typical marketplace, but not really bad, but you're clearly not in a strong seller's marketplace. And that's compared to the 10-year median. So what that's saying, it is a strong market, don't get me wrong, but the market is not as strong as it typically is for this time of the year. This is typically the strongest time of the year, although we are past the absolute strongest. And you can see the absolute strongest is basically sometime right near the beginning of second quarter, which is right around the April 1st. You know, you could say that this year was delayed a little bit since I'm calling it closer to April 26th or April 19th. Here again, you can see the gray line is where you'd expect it to be. You can see you're above it, so you're slower than a typical marketplace. So still low numbers, and we'll be getting to that, but still slower than you would expect. Here's marketing time. Here, you know, it almost doesn't make sense, but there is a difference. Marketing time is down here at 14 days. Yes, it's been down as low as 12 days, and I don't think it's ever got down to 11 days in the very heat of 2022. So being at 14 is pretty aggressive. Here's where you'd expect it to be on the gray line. The blue's the highest you'd expect. This is the time that it takes 75% of the sellers who are successful in selling. Same concept again, you pull it out, you can see that you're below. So sellers are selling quicker, less time on the marketplace. And part of the reason for that is we don't have any listings that have been on the market, or very few listings that have been on the market for 60 and 90 and 120 days, because those would get pulled into this days on market if they were out there to sell. If you have no properties that have been out there for any period of time, the number's obviously lower. This is ask price. I've changed the presentation of this a little bit, and I hope it's not too confusing. The other one was very confusing for me. The zero line is up here. When you're above zero, that means sellers were raising their price, and that does happen. You can see you had one bubble here right in 2022 and another bubble back here in 2018, and potentially one back here in 2015. So sellers do on average raise their price. It's pretty uncommon. You can see the red hot marketplace is typically running below. And again, you can see it's a tight metric because for the most part, the red line stays at above 0.6. So sellers only taking 0.6% reduction or less. The gray line is where you'd expect the market. The purple line is the actual data. The blue line is the most you'd expect. So you can see that we're right down here, just over 0.6% of the ask price is what the typical seller is reducing. Now, that's not what's happening, of course. It's something like 12% of the sellers are doing a 5% price reduction, that kind of thing. Very few sellers do a price reduction, but the sellers that do price reductions are pretty significant. Here's the same concept where you pull out the gray line. And here, it may seem weird, but the pink goes below the 100%. And that's because even a small price reduction is still a hot seller's marketplace, as you saw in the previous slide. So you have to get down here to almost 1% price reduction. And right now you can see we're at 1.5%. Here's the frequency of the sellers reducing their asking price. So right now you can see we're only having 12%. So it's pretty close, you might guess. 12% of the sellers are reducing their asking price. So that 12% being reduced means that 88% aren't reducing their price at all. Some of that 88% are probably raising their price, but that 12% with the 88 gets balanced out. So it's only, what did I say, 1.5% reduction overall. So if it was 10% of the sellers doing a price reduction and it was 1%, which are roughly approximate, that would be the 10% of the sellers that are doing price reductions are doing a 10% price reduction on average. And when you do look at it, you can see that there are some sellers that are taking 20% price reductions. But again, the number or frequency of those is really low. And here again is the frequency. So it's a little bit more common, about 10% more sellers reducing their price now. So if the number is normally at 12%, 10% of 12 is 1.2. So it'd be 13.2% of the sellers. That's the concept here. So slightly more sellers are reducing their price than typical. Here's the average overbid. So this is flipping over and looking what the buyers are doing. So this now is lagging. The price reductions, you can see that without waiting for escrows to close. This is, you need to wait. So this is lagging behind. You can see the overbidding is getting less aggressive. We were up here at 108%. We're now down approaching 104%, 107%. So basically 1% less price reduction in just the last couple weeks. Here again is the same thing compared to normal. So again, you can see we were hotter than normal, but we're rolling over now. So we're cooling more rapidly than we normally cool for this time of the year. Here's the frequency of overbidding. Typically, you'd expect somewhere around 74% of the sellers to be getting overbids, and the number looks like it's closer to 78% of the sellers are getting overbids. So basically, almost 80% of the sellers are getting more than their asking price. In a real hot marketplace at this time of the year, you'd expect it to be up around 84%. Here's the frequency. So you can see right now overbidding is more common than it typically is. Normally you would be right down here at 100%. So you're somewhere around 106%. So 6% more frequent than typically. Here's the long-term appreciation. This is on log paper, which I personally prefer. You can draw a straight line through and get your appreciation line. So you can see that we've gone up. The most notable thing to me is this dip down, the V dip down every year. Or you can say another way to look at it is the predictability of the upside V coming into the new year. Just after the new year, you have the run up. So that's what we have. Now you're going to have a recovery and you're going to come down and most likely get down to or below the line by the end of the year. Now that's not property values necessarily, because the type of homes that are selling changes also throughout the year. This is the payments. Here's the cheapest home. So in Silicon Valley, you can get a home with a monthly mortgage payment of about $7,500 if you're buying the cheapest 10% home, just under $14,000 for the typical home. And if you were to buy the most expensive 90% home using an 80% loan, which would be very unusual, your mortgage payment would be about $28,000 a month. I want to spend a time, I don't remember pointing this out last week, but now we are back to the worst year out of the last 10 and the worst year out of the last 25 years. Here are the actual numbers. COVID, you can see, had been lower, and that was because we couldn't even show properties for a while. Now COVID is the second lowest, because 2149, which is where we were last week, is below 2258, and 2300 for COVID is higher than 2057 for this year. We are clearly having a lack of transactions. So the buyers are out there, but there's not nearly as many as there typically are out there. Now what we're doing is looking at all three counties. Santa Clara County is in the blue, San Mateo County in the orange, and Alameda County is in the gray. You can see that's the normal order. Gray historically has been the highest. It's the sort of the largest county. Alameda County and Santa Clara County were sort of neck and neck shortly after COVID. But you can see that with the 2023 recovery from the 2022 slowdown, Alameda County again returned to its normal pattern of having more active listings, and it's returning that pattern again. But here's a pattern that isn't returning. Here's sort of the reverse. Santa Clara County is typically second place to Alameda County, or call it tie, but now Santa Clara County is clearly on the top and outperforming Alameda County as far as the number of offers. So Alameda County is slower than you would expect compared to Santa Clara. Or you could say Santa Clara County is performing better than you'd expect based on Alameda County. Here's looking at days of unsold inventory. You can see that Santa Clara County down here in the blue at 30 days, which is a very respectable marketplace. I consider anything under 40, 42 days to be a strong seller's marketplace. So even though we're talking about it being slower than a year ago, it's still a strong seller's marketplace. Alameda County is the slowest at about 43 days, and San Mateo County is in second place at about 38 days. You can see that they're fairly close, but historically, before the pandemic, San Mateo County was the fastest. I would say that Santa Clara County used to be second place, and Alameda County used to be the third. So San Mateo County is the one that really changed from being the fastest to being the second slowest. And for a while there, it was actually the slowest. The relative separation between Santa Clara County and Alameda County is relatively unchanged, with San Mateo County doing the big change. Here's marketing time. Santa Clara County has the fastest marketing time at 16 days. Alameda County is next. It looks like at 19 days, followed closely by San Mateo County at 20 days. So all three counties are very acceptable time frame. You know, if you went to anywhere else in the country and the sellers, you told the sellers that 3/4 of you would sell in under 3 weeks, they would say fantastic. Here's looking at the ask price reductions. San Mateo County is by far taking the most price reductions right now, and they're taking a 1% price reduction. Santa Clara County is in second place at about 0.6%, and Alameda County is doing the least price reductions at about 0.4%. This is the frequency of price reductions. They're all fairly close together, but San Mateo County is taking the most frequent price reductions, followed by Santa Clara and Alameda. So even though Alameda County wasn't doing as well as far as the number of transactions, it's doing better as far as the frequency and magnitude of price reductions. Now we're flipping over and looking at overbidding. And overbidding, Alameda County is doing the best, which, you know, you'd almost expect it not to be, because Santa Clara County has the fastest marketing time, the fastest DUI, but Alameda County has the most overbidding. So the buyers feel that that's the most competitive marketplace. And look at Santa Clara County's slowdown. It was at 110% basically early in second quarter, and it's down now to 108.5%. So it's a 2% drop from 10.5 down to 8.5% overbid. So that starts to be pretty significant when you talk about the typical price being somewhere around $2 million in Silicon Valley. Here's the frequency of overbidding. Frequency doesn't drop off as much. So even though you've had a 2% drop in the average overbid, the frequency is pretty flat. And that's why I put the magnitude of overbidding first, is I've noticed that the magnitude tends to drop quick first and greater than the frequency. And basically what that's saying is the buyers are still willing to overbid. They're just not willing to overbid as much. Here's the long-term appreciation. You can see that all three counties basically appreciated at the same rate until we hit the pandemic. And since the pandemic, Santa Clara County has been doing the best. San Mateo County had been doing the worst, but in recent weeks, it has turned around and is now outperforming Alameda County. Here's a long-term sold price. And again, this is on log paper. You can see that San Mateo County came down a little bit last week, and it's now again slightly under its previous peak. Santa Clara went up and is now really starting to distance itself from its previous peak. And Alameda County is the one county that's significantly still below, but only for a short period of time, its previous peak. This is on regular paper for those that prefer. Here's the estimated payment. The formula is the same. It gets a little different in shape because the interest rates impact it. Here is the actual raw numbers, whether you're interested in Santa Clara County, San Mateo County, or Alameda County, or the valley as a whole. You can see the individual raw numbers. It looks like my active inventory did not get updated, so I apologize for that. And then your number of offers, everything else looks like it did get updated. Here's the heat maps that I talked about at the beginning. You can see that pink in color is a shortage of inventory. Most of Silicon Valley is between 87 and 112% of the inventory you'd expect. You have to be below 87. You have to be 12% above or below 100% in order to be pink in color. So there are a few pink in colors, and you can see basically the heart of Silicon Valley and a real small micro market area that I'd almost ignore here, Phosphor City, because it's basically noise. When you don't have a large data set, it fluctuates a lot. Here's your offers accepted. You can see across the valley, it's basically blue in color, which shows the lack of inventory, lack of offers accepted. Here's your days unsold inventory compared to the normal. So here's just comparing it to where you normally are. So Alameda County is slower than it normally is. The San Mateo County coast is very slow, and most of Silicon Valley is about where you'd expect it to be. Here's the actual days unsold inventory. So even though it's slower than normal or about normal, here is now just the raw count showing that it's still a strong marketplace. So even though it's typical, it's a strong marketplace. You have to be basically from 1 to 6 weeks to be in a red hot seller's marketplace. And you can see that's where the vast majority of Silicon Valley is. Here's your time. So this is 75% of the sellers are successful. The only area that's over basically 6 weeks is on the San Mateo County coast. Most of the areas are selling somewhere right around 2 weeks, which is pretty incredible when you think about it. Here's the ask price reductions. So you can see the coast is taking fairly significant price reductions. You can see that the Fremont area is taking very little price reductions, as well as East San Jose is taking very little price reductions. Here's the seller's ask price reductions across the board, red in color, except for the San Mateo County coast. Here's the magnitude of overbidding, fairly aggressive. The city of Alameda up here is doing pretty well. It's probably the hottest out of the whole group at 22% overbid. That's just insane. That's 1/5 of your ask price over what you're asking. This is the frequency of overbidding. So across the board, it's very high. I consider anything over 50% overbidding to be a seller's marketplace. Here's the long-term appreciation, and you can see it's sort of the outlying areas that have had a higher appreciation rate. The areas that used to be close to the job center, people just aren't willing to pay the huge premiums anymore to be close to the work center. And this is sort of interesting. The appreciation in the city of Alameda is lower than you would expect, and yet they're having 22% appreciation. So maybe people are overbids. Maybe people are seeing that it's underpriced for what it typically is. Here's your affordability, just price. Here it's not based on market conditions. It's just where the price is most affordable. And you can clearly see it's the outlying areas. The more expensive areas are sort of the core right along the Santa Clara County, San Mateo County border. And instead of just following the median price, which is the middle number, I follow the 10 percentile and the 90 percentile. So I sandwich it. And here's a recap so you can pick your micro market area on the left and see the market and market conditions, or you can come over and find out what micro market areas you can afford based on either payment or price range, and go back to the left and see the condition experience. White doesn't really tell you the condition of the market. Yellow is the most current indicators we have, whether it be days on unsold inventory compared to the 10-year median, days on sold inventory just now, time on the marketplace, price adjustments, magnitude and frequency. Those don't have a lag time. The orange up here have a lag time because we need to wait for escrows to close. So yeah, that 4 to 6 week lag time. And then we'd get into the Greater Bay Area, and we'll do that afterwards. So I will stop and see if anyone's got any questions for me. I'm not seeing any unmuted mics. Now we're going to move on and talk about the Greater Bay Area. That includes Silicon Valley as one of 5 regions. San Francisco and Marin are the cities. The North Bay is Sonoma, Napa, Solano, Contra Costa. Central Valley is San Joaquin and Sacramento. And the Central Coast is Santa Cruz and Monterey. So starting off with the raw numbers so you can figure out which metric you think is most important for what you're trying to determine. And then you have the county down on the left-hand side. Here is the first data slide with the active inventory. You can see inventory in all 5 regions is growing. It's below where it typically is. All you have to do is come back to the left and sort of draw your own line over. So all 5 regions have less inventory than they typically do. Offers accepted. Silicon Valley is starting to get back up in the realm of where it typically is, but it is still definitely down. I think from the earlier part of the presentation, it's at 90%. North Bay is in the same category. Central Valley is probably down more significantly. It's normally right up there with Silicon Valley. So if Silicon Valley is down, Central Valley is now below Silicon Valley, so it's down further. It looks almost normal, and Santa Cruz Central Coast area looks a little bit below. In general, there's a lack in all 5 regions. The speed of the marketplace is measured by the days on sold inventory. Silicon Valley is obviously the fastest. You got a group of 3 real close together, and Central Coast is the slowest. And if you look back historically, Central Coast is the slowest and Silicon Valley is the fastest. Silicon Valley looks like it's about the same par of where it typically is. Central Coast actually looks like it's also on the par. I'm not sure. I would say the other 3 regions look like they're a little faster than they've traditionally been. And that makes some sense if it's becoming less of an hindrance to have remote working. This is the time to market the properties, the 75th percentile. Again, the order is about what you expect. Silicon Valley historically is on the bottom. The Central Coast is typically on the top, but in this case, The North Bay is actually on top. You can see it's at 30 days, where the Central Coast is about 27 days. But again, clustered fairly close together. The big takeaway here, in my opinion, is Silicon Valley is doing significantly faster marketing times. This is sellers' price reductions. Silicon Valley, again, is coming out on top with the least price reductions. Central Coast, surprisingly enough, is right up there with it. And one of the things you'll notice in the Central Coast, the blue line, it's bouncing a lot more. It has less data points, so you get statistical fluctuations. So this could be an up bounce. It's hard to tell. That's one of the reasons I don't do individual zip codes. There's just not enough data, and it bounces to the point where you can't make heads or tails of it. The cities area is doing the worst. And the cities area, as you'll see in the slides coming up, is doing pretty poorly overall. This is the seller's frequency of ask price reductions. So this tells you where the seller's expectations are compared to the marketplace. Silicon Valley has the least frequent price reductions, and Central Valley has the most, followed by North Bay. Then the cities, and Central Coast is in second place. As far as magnitude of overbidding, areas where buyers are coming in and overbidding the most, Silicon Valley and the cities are tied. So that's a category where the cities actually does fairly well. Historically, before the pandemic, you can see the cities was typically above Santa Clara, San Mateo, and Alameda being Silicon Valley. And right now, since the pandemic, they've basically been tied, or Silicon Valley's been on top. The order of the other three regions really is unchanged, with the North Bay coming in third, Central Valley coming in fourth, and in last place, the Central Coast. Basically, the Central Coast is, doesn't have a lot of job centers, and it's getting a little bit more remote, so it's less dependent on Silicon Valley's economy. The Central Valley and the North Bay, there's a lot of commuters that go there. There's fewer commuters that go to Monterey, although there's, some that do. Monterey and Santa Cruz is about the same time as getting out to San Joaquin area. This is the frequency of overbids. So how common are overbids? Most common area is Silicon Valley. Cities is in second place. Those two historically have been very close together. I would say the cities has dropped down a little bit. North Bay and the Central Valley are fairly close. And again, coming in last place is the Central Coast areas. Here's the long-term appreciation. And the big takeaway here is the cities has had the least appreciation. You can see traditionally, before the pandemic, all 5 regions went up fairly similarly. Yes, there's bounce, and you can see there's the most bounce in the Central Coast area, as I was mentioning earlier. But the real takeaway is once we hit the pandemic, the cities area fell to the bottom and has stayed there. Recently, Silicon Valley has come out on top and doing the best overall rate of appreciation. Here's the sold price, and this is median. The cities of Silicon Valley are very close together. I do believe Silicon Valley is on top of San Francisco and Marin. Pretty unusual historically. There has been a few times that's happened, but I believe this is one of them. It's definitely been above right here. You can see that there was a bigger dip down. Then the Central Coast is in third place, basically, followed by North Bay and Central Valley. So there's been no reversals of significance, but in the top 2 tiers, the cities has dropped down relative to Silicon Valley, or Silicon Valley has caught up to the cities. This is what the payments would be, and because the prices are the same and you go through a 30-year fixed mortgage, 80%, the ratios are going to be the same. And with that, we're done with the presentation. Thanks for watching. Take care, and don't forget to subscribe and like if you made it this far.